plus. And at one point, I was the youngest chief compliance officer for an SEC RI in the country. So today, I'm pretty excited about this call. It's one of those topics that nobody really wants to talk about, right? And the reason I just selected this topic is because it's so relevant for this group, right? Everybody's so entrepreneurial and everybody's a go-getter and everybody has a great ideas and has the competency and grit to take action on those ideas. And it's just why I love this group. However, I've been asked to be a part of a few funds recently, and while I'm honored, it raises concerns. It's like, I don't really know some of you folks, right? I also know folks that have met other partners through Black Card, and they hopped in quickly, and it's very exciting, but it raises concerns too. So we've heard a couple quotes, date before you get married, right? Get a prenup before launching a fund. What does that actually mean, right? So this call is about partnership agreements and when to have these difficult conversations with potential or even existing partners, right? And kind of my view on this is that we are out raising money, right? We're working with other people's money. And I think we have a fiduciary obligation to our investors to just do the right thing. And part of that is making sure your own house is in order. So what does that mean? That means sitting down with your partners and an attorney and working through some of these various unfortunate scenarios that may arise, ultimately to do what's best for the operation and your investors. So Dan Doxey, one of my favorite coaches, right? He's the real deal. He talks about the 3Ds, right? Grab a pen, write these down, right? Death, disease, and divorce. So if a general partner dies, is there key man insurance, right? Is it agreed upon that ownership passes on to family members? Do those family members have voting rights? Or let's say a general partner doesn't die, but they're hospitalized and they're just out of commission and they own 40% of the GP. What then? All right. So anyways, I've got my good friend, Marty Tate on. He's my go-to SEC attorney. He's a nationally recognized securities attorney. He's set up over 100 funds. He's into private equity, real estate, venture capital, blockchain, Forex. He's done oil and gas for me, domestic, offshore. And it's kind of a big deal if you know what this means, but he actually co-authored the 2012 Jobs Act, which basically created regulation crowdfunding. He's worked with big names such as Grant Cardone. And Marty, correct me if I'm wrong, but didn't Bridger's older brother used to intern with you, and didn't you set up Bridger's dad's first funds?
Yeah, that's correct.
He's awesome. So let's hop into it. Marty, with your experience setting up 100 plus funds, you've seen the good, the bad, the ugly. And in this group, the current MO is we've got deals, we're raising money, let's start a fund, let's get through their legal docs, right? Let's get it done. And now we're fund managers, right? But I'd like to just give some advice, like, hey man, let's slow down a little bit. So just starting off, what advice do you have for these emerging fund managers within this community who are looking for partners or have fairly new partners?
Yeah, so I think it's a great topic because it's something that we probably don't spend a lot of time on. Generally when people talk to me about their fund, we talk about the terms of the fund, we talk about management compensation, we might talk about different mechanics within the fund documents, which would be typically found in the your limited partnership agreement or your operating agreement. But the general partner or the manager of the fund, a lot of times when we put together those fund documents, we don't spend a lot of time on that, talking through that. It's typically like, hey, we're putting together this fund, and we spend all the time on the fund documents, what regarding the investors, but the manager's operating agreement or the GP agreement, we don't dig into a lot. Typically it's, and what I see out there is a lot of times it's just something that's kind of off the shelf and doesn't go into a lot of specifics. But I think that you raise a really good point, which is you're getting into this relationship with a partner as you're going about launching your fund. It's really important that you take the time to make sure it's done right, and like you said, sort of plan for the divorce. Every time you enter a partnership, everybody's excited and they think, hey, this is going to work and things are going to go great. And hopefully they do, but a lot of times they don't. One partners might get sideways with each other. Somebody might lose interest and just say, hey, I want to go do something else. Like you said, there could be a death, there could be a disability. So I think it's really important to take the time to make sure that those documents, that the agreement for the GP, or the manager, that's well done also, and that it has the necessary provisions to plan for those events. I mean, Ryan, I kind of went through that, with one of your ventures, and it was hard. I know that was hard for you, and we spent a lot of time talking about, well, what can we do and how can we do this. So definitely something that's important.
School of hard knocks.
Yeah.
That's why I bring it up for everybody, because I went through this on a previous venture, and it's like, man, difficult topics, but necessary. And kind of my experience this was all done before Black Card. But it was like, hey, let's rush through the legal documents, let's get it done. And then when it came back to the shareholder agreements and the GP agreements, it's like, hey, every little clause in those agreements was being looked at of what does this mean? Because it's really important now if you're trying to, you go sideways with a business partner. What do these clauses mean? So it's really important. So Marty, could you share a story or two? You've been through enough of these funds. Do you have a story where general partners go sideways and how it possibly could have been avoided? Maybe there was a divorce or something like that.
Yeah, and I can speak actually firsthand. So so I started off in private practice. I was with a large firm in Atlanta, and then I moved to Salt Lake and was with the biggest firm here in Salt Lake. And then I actually went into the other side and was in-house counsel for a few different investment firms, and then ended up as general counsel and a managing director for a company called Harbor Capital, and we managed multiple funds. The biggest fund that we managed was, and it was at that time that I actually met Bridger's dad, John. John was starting up a new fund, and his first fund actually was just strictly designed to syndicate with my fund. So they were going to just come invest alongside us. So help them with that. But Harbor, we were heavily real estate, had a huge debt fund, and then an equity fund, and we actually had a venture capital fund, and we had a marketable securities fund. And in 2009, the 2008, 2009, the real estate market collapsed. You had collapse of Lehman, you had the mortgage industry kind of got turned on its ear. You had, there was all these secondary subprime mortgage loans that were shorted. Anyway, it's those of us, I don't know if Ryan's old enough to remember, but the rest of us, were those of us who lived through that. It was tough, and that partnership ended up kind of going a little bit sour as well. And I was like right in the middle of it. You had two partners that saw things very differently on how things needed to proceed. And, one partner that wanted to just basically leave the dumpster fire of the real estate fund and move on to the venture fund because that had some good investments in it, and kind of wash his hands of the liability there. So we ended up, there. It was at that time that we looked, and the documents weren't great. There weren't clear. There wasn't clear language about what happens if a partner wants to just leave. There wasn't clear language about any sort of obligation to the fund. And so, there was a lot of, it ended up kind of being some, bad feelings. Ultimately, the parties, worked it out. And luckily there was the other partner, main partner was just a overwhelmingly, just a fantastic guy, and just kind of said, oh, well, I'm just going to do what's right. And unfortunately, that's kind of what happens a lot of these cases, but not, you don't always get somebody that's going to take the high road. And so that's one instance. Another instance is we had I had a client that, again, things, they started off great, and then things went south, and partners started not getting along, and both of them wanted to continue, but they wanted the other partner out. So that's a tricky situation. And kind of both of them want to continue doing managing the fund of the company, but they want the other partner out. In that situation, and what happened there is there were two partners, and everything, they were the managers, and all company decisions had to be made with, the documents that had been drafted said that everything needed to be approved by a majority. Well, when you have two partners, it's really hard to get them. If they don't get along, it was impossible to get a majority, including, any sort of partnership thing. So they basically ended up being in this deadlock. I mean, they couldn't move forward. One wanted to go one way, one wanted to go the other way, and they couldn't move forward. And the documents didn't provide for that situation. So we, and these were not documents that I had drafted, but we, ultimately, one partner, just kind of, and then they said, well, hey, I want to be bought out, and there weren't terms on that. It just got ugly, and it dragged on forever. I think that, ultimately somebody just, after like a year or two, just said, forget it, I'm tired of this. So, okay, so those are a couple of stories. So I guess the question is, okay, how do we avoid that? How do you avoid those situations? And so in your partnership agreements, it's really important that you have a couple of things that are addressed, not your general partnership agreement. You need to have a situation, especially if there's just two of you, you need to have language that addresses what happens in case of a deadlock, right? And this might not be like, hey, we want to leave or anything, but you might just come to a situation where you might see things different. Maybe it's just an investment. You say, hey, I want to do this investment. The other partner says, I don't. So it's good to have provisions in there that maybe, investment decisions need unanimous approval of the managers. If there's other things that require a majority, and you have a deadlock, a lot of times it's good to have an advisory board that can break the deadlock. It's always actually preferential to have 3 people at least, so you don't ever come into the deadlock, but that's not always the case. So, and then the third thing is just having really good, it's a language to address what happens if there is a deadlock, and how to deal with that. A lot of times what you'll have is basically in those situations, you'll have buyout provisions which kick in, and there's I don't know, there's different things they're called, like the better, auction provisions that basically say, okay, great. You either, I'm going to give you a price. You can either buy me out at this price. I can't remember the name of it. Maybe somebody can chime in, but it's basically like, you name your price that you'll be bought out at. But you also, if you're willing to buy that other person out at that same price, there's a fancy, probably politically incorrect name for it, for that procedure. But
like a buy
anyways,
sell. Somebody mentioned in the comment a buy sell agreement, or like
yeah.
a
So
warrant maybe, or
so you have a buy sell, but there's something like a Dutch auction or a Russian auction, or there's something that was like, I remember it being called. So or anyway, so those somebody just had a push pull, which is something like that. So those are some ways that you can possibly address it. Sorry, I'm talking a lot as always. Sorry.
That's all right, Marty. So that was super informative. Thank you. So have you seen something like a vesting schedule in these GPs? Is that happen?
Yeah, I mean, and that is a good idea, especially so it kind of depends. I mean, if you and your partner are going and starting this business, it's not super typical to have a vesting schedule, but it's possible, right? That each partner vests as they go on.
Can you give a vesting 101 what that is and how it works?
Yeah. So and in this situation, so vesting just means that the number of shares or interests in an LLC that you get kind of vests over time. And typically what you'll see is like a 3-year vesting schedule. You'll have a 12-month hurdle where basically a third will vest, and then typically you'll see it so the remaining 2/3 will vest monthly thereafter. So that would be a typical vesting schedule. But a lot of times what you'll see is to avoid tax issues, you'll have all of the shares vest up front, right? Because when the company doesn't have any value. So say Ryan and I form a partnership and but we want to have some sort of vesting mechanism. What we would typically put in place, what we might put in place in this situation is, okay, we each have 50%, and our 50% will vest equally over 3 years. But say I decide to leave after a year, then what we'd have is all of it would be granted up front, and then Ryan would have the company would have a buyback provision, which would allow them to buy back my remaining shares that had not, or interest that had not vested, at like a penny or something like that. So that's a way that you can see that done, so that it minimizes the tax liability, but it increases but it allows you to have that mechanism in case I decide to be a flake and leave Ryan holding the bag.
Right. Man, thanks, Marty. That's super helpful. So at this point, I want to leave time I'm sure there's plenty of questions from folks. So I'd like to open up for Q&A now, but in the chat, I see a question from Richard. If you're the primary GP and someone wishes to invest as a GP with you, how do you price their shares?
So it's a great question. It depends on when they come in, right? So if they decide to come in the beginning, then you guys can both kind of pony up and say, hey, we're each going to put in X amount of dollars, and you can base it pro rata. If I put in 10 and Ryan puts in 20, then maybe I get a third of the GP shares and Ryan gets 2/3. If you already have the GP and it's established, and somebody comes in later and says, hey, I'd like to invest in the GP, which that sounds like the situation that Richard's talking about, then really what you're going to do is you're going to, there might be some sort of valuation mechanism you go on based upon current revenue or pro forma revenue that you can value and say, and we're going to value it at a 3x based on revenue. But more likely than not, you're just going to have some sort of negotiated price and say, hey, based upon the revenue that we have, we think that, the GP is going to make, $200,000, this year, and over the next 5 years they're going to make $2 million, and so we'll do a 2x revenue model, and so we think the company's worth 10 million, so you're buying your $1 million buys a tenth. I don't know. I mean, that's just back of the napkin example, but it's really hard. I mean, valuing a GP is really a difficult endeavor to value, because your value is based upon the value of the carried interest. And especially if it's a real estate fund or something like that, or a venture fund, you don't know the upside. So.
Great question. Any more? Gary, you got any questions?
Oh yeah, I do. Good to see you guys. Yeah, I wanted to know, I've got a partner that I'd like to bring on, but this is my company, my program. I'm the expert. I just think he would be a great asset to bring on. So is there a way to set up the GP where I have the majority of voting rights, to where the final decisions always come to me? But yet, it's still the assets would be a 50-50 split to keep them motivated. I mean, do you have to set up two classes of shares, or is there a simpler way? I'm just looking for the most simple way to set that up.
So, two classes of shares, that might be an answer. I mean, if you want to provide the reason for doing something like that is if you want to designate different rights, right? So if you want to say they're not voting, or they don't have voting shares, but they want to invest just as an economic vote, or if they have a preference and you want to say, hey, we'll give you your money first. We'll give you your money first before we take money out. So that might be an answer, but or if they want to prep and they want certain things, sometimes you'll have what's called a participating prep, where they get their money out first, and then they also participate in just with the rest of the shareholders or interest holders. Does that answer your question?
No, I mean, I guess I'm just asking is, how do I go 50-50 with a guy, but I maintain the controlling vote or the rights or whatever, to where we'd never have a deadlock. And, and he understands that up front. And then maybe when I join in on his fund, then it'll be the reverse. I'll be just the financial side or whatever, and he'll be the one running it, kind of thing.
How about 51%, Gary?
Yeah, I guess that's pretty close, right? I guess that's probably the easiest way.
And it really, you could set up voting rights and economic rights within the unit, so that you can allocate voting rights, and you can say you have 100% of the voting rights, but 50% of the economic rights. I mean, with one of the nice things about LLCs is they're super flexible. So like, you wouldn't even need to do, and I'm sorry, Gary, I didn't answer your question more directly, but in those situations, you could have voting shares and non-voting shares and treat them the same economically, but through an operating agreement, you could literally set up your voting interest and your profit interest, and your voting interest is 49% and your profit interest is 50%. I mean, it's really simple.
Okay, perfect. That's what simple is the name of the game for me. I appreciate that. Thanks.
Okay.
Nicole, I know you have some questions.
Actually, I don't.
No?
I covered a lot of this actually kind of proactively in my own PPM and operating agreement just recently. So, I kind of had some forward thinking thought, although I am going to revisit the buyout. We have a fair market valuation and all this other language about buying out a partner, but I think I'm going to retweet that. But no, I think this is all good stuff.
Russell, are you there with Brandon?
I'm here by myself.
Oh, you are? Do you have any questions, Russell?
No.
Hey, Russell, I am listening.
Yeah, we're full ready for a divorce. We talk about it every single day.
We're different offices today.
Yeah.
Uh-oh.
all good.
All right. Any other questions, folks?
Yeah, I have one. Is there a method or approach that we can use to take on partners in kind? As in, instead of taking cash contributions from LPs, what if we took contributions of land or access to properties in place of the actual cash?
Yeah, so what you're talking about there is on the investor side, right? The limited partner side, or and so the way that that's complete. I suppose. I mean, it kind of depends on your fund documents. Sometimes fund documents will prohibit that type of investment, and so the investments have to be made in cash. But in those situations, we've done real estate funds where people will come in and say, hey, we're going to contribute these 3 projects in exchange for an LP interest. And then it's just a matter of valuing that, right? So then you'll say, we value those properties at $3 million. It's the same as making a $3 million cash contribution, and we'll issue the corresponding number of limited partnership interest in the fund. And so that way investors now become part owners of that project, and that person who contributed the property now becomes, a part owner to the other assets of the fund.
Gotcha. And then what about on the general partner side? Is it also possible to do the same thing?
So I guess maybe help me understand why it is possible, yeah, but why would a general partner contribute? I can understand like services, right? Because a lot of time you have services, but like what would the purpose of them contributing something to at the GP level?
So kind of just thinking about it, if I wanted to do a land development deal, and if I know a couple folks that have good years of construction experience, some folks that have large plots of land, and I want to kind of set up the fund structure so that we all could kind of benefit in the waterfall. Is there a way to do that such that it helps us to? So we have a project that we can advertise to our LPs that we bring in for additional capital to fulfill the project.
Okay. But to me, that still seems like it would be better to put that at the fund level instead of the GP level. But I guess to try to answer your question, if you wanted to do it at the GP level, 100% you could. It's being contributed, and what the corresponding amount of interest would be allocated.
Gotcha. I appreciate the record.
Hey, Marty, this is Chris Murray. Can you hear me?
Yep.
Hey, just a quick question. I joined late, so I might have missed this. I apologize. Can you tell me what the best way to structure a buy sell on a 3-way, so we each own the 33% of the GP? That's my first question. And then the second question is marketing expenses related to industry trade shows. We're in the real estate space. Going to trade shows, staying up with, sector information. Can that be, is that more suited when an investor's optics on the GP side, or can it be included in the fund side, do you think?
So I'll answer the second question first. Typically those types of expenses, like, promoting the fund, due diligence on assets, trying to get deal flow. Typically those are fund expenses, but that sometimes is a negotiated point, and sometimes the LPs might push back and require, typically in your partnership agreement, you're going to have a list of funded expenses and you're going to have a list of GP expenses. But I've seen those type of expenses more fall in the fund side. Whereas GP expenses are kind of, your overhead, your salaries, travel is actually, I think, one of those things that's kind of could be either way. I know like on a real estate fund, sometimes if they're going to see different assets and stuff, that would be a fund expense. But trade shows, like I said, I think you could put it in either bucket. The buy sell question between three of them, typically like if one partner decides to leave or needs to go, the other two partners would have the equal right to buy that partner out. And then if one of those other remaining partners didn't contribute their fair share, then the other partner would have the ability to buy that. So that person's, whatever they didn't buy. So that's the way I typically see those structured.
Got it. Okay. And then one last question, sorry, and follow up. Do you see investors when they look in their diligence at the GP level on a key man policy, do you see them requiring it on all three? Or if you've got somebody who's deep into the finance side of the business that might have a little bit more weight on the experience of the team versus capital raise or operations, have you ever seen a weighted, or do you think they require it a key man on each?
It really depends on who the key person is. And so typically you'll see it just on like the main part. I mean, you'll see it on one or two people, but not on the entire team. But I guess it depends on the value of all the people. Then it'd just be up to you to convince them why that person wasn't that important.
Okay, thank you.
Hey, Marty, would you mind expanding a little bit on that, the avoid tax by vesting program that you were talking about, the 50-50 up front and then a buyback provision for 1 cent per share? Would you explain that for a layman for me?
Yeah,
Appreciate it.
So the idea would just to be, and I'll use, Ryan and I are starting a partnership, and we each are granted, let's say we're each granted 100 shares in the GP. And we would get those right up front. We'd get all of them up front, but those shares would be restricted from an operating agreement or from our, an agreement standpoint, contractual, so that, and the restrictions would lift over a 3-year period. So we would have like a 24-month cliff or would lift, not subject to a buyback. And then over the next 2 years, then, restrictions would basically lift as the time went on. So say after 2 years, I decided to go, the remaining, so 1/3 of my, 2/3 would be unrestricted and you couldn't buy them back, but 1/3 would be restricted, and the company would have the option to buy those shares back at like a penny a share or something. So that's the way that would work.
Okay, you cut out on a lot of that, so I missed a good section of that. It might be my side, I don't know, but I guess I was trying to understand the buyback at a penny a share provision. You say that's just for a third portion of it versus the 2/3.
Yeah, sorry, I'll take my video off and see if that helps. Can everyone hear me? I've got a couple, it's popped up and said internet unstable a couple of times, so.
Yeah, I can hear you okay.
Okay. So I was just saying that they basically, all the shares would be restricted and subject to, and then the restrictions would lapse over time versus, vest, the restrictions would lapse, so that at the end of 1 year, 1/3 of the restrictions are lapsed. So those shares would not be subject to a buyback. So if I left at that time after a year, Ryan, the company could buy back 2/3 of my shares for, a penny like a penny or something like that.
Okay, gotcha. And that avoids the tax implications on the partner then.
Yeah. Yeah, because
Okay,
everything
got it.
would be granted up front when the company doesn't have any value.
Okay, that makes sense. Okay, perfect. Thanks.
Gary, I just put a link in the chat. There's quite a few different ways to do vesting schedules, and but it's a tool that you can learn about and, sit down with your attorney and it's like, hey man, what's the best milestones or metrics or time length for the person you're trying to bring on. There's a question. I think I've been getting asked this question a lot, and I think this is a whole topic, Marty, that we should cover. But somebody asked, can non-US citizens invest in US funds? And I think topic of Reg S comes up, but yeah, can that be done?
Yeah, absolutely. There's no prohibition from investors. So one of the things that you have to be aware of, though, is if they invest in US funds, they're going to receive a K1. And does that non-US person want to be subject to US taxes? So that's a reason why for a lot of funds will set up an offshore feeder fund. I only recommend that if you've got significant dollars. Otherwise, I just basically make them, if they really want to invest, just say, sorry, you're going to be subject to US taxes. The Reg S exemption that Ryan mentioned is basically, so if you're raising a fund and you're using a Reg D exemption, you can basically, Reg S means you can sell to non-US investors. And really what that means is the SEC, they don't care. I mean, they're there to protect the US investors. So if you're a resident of the UK, the SEC doesn't really care. It's basically saying as long as Reg S, there are things you have to comply with. You can't have what are called direct selling efforts within the US. So they have to make certain representations about them not being a US person. But yeah, sorry, long answer, short question. Yes.
Any other questions?
Yeah,
Oh,
I had a question.
I do have a question in regards.
Hold on, go ahead.
I do have a question in regards to Reg A plus fund setup. I know, Marty, you're a specialist in that. I just had a Black Card member just joined and yesterday, and they're very excited about launching a Reg A fund. I don't think they were able to join us on this meeting, but can you go just really briefly over the amount of reporting that is required for a Reg A fund, or what would that look like with your services?
Yeah, happy to help and happy to talk to them as well. So a Reg A fund, and I basically it's a fund that's using Regulation A to raise capital, which generally is prohibited, depending on the type of assets. However, we've structured. Ryan did a Reg A fund. We did that with them. We have other quote unquote funds that are using Reg A to raise capital. Under Reg A, the difference, Reg A allows companies to raise up to $75 million from accredited and non-accredited investors. So it's a huge, benefit and a lot of upside. Again, it's limited to the types of companies that can use it. It does require that you register with the SEC. It's a reviewed filing. So it takes time and, can take 6-12 months to get that thing approved. And then once you are approved, you have to do annual and semi-annual filings related to your financial statements. So annually, you have to file your audited financial statements, and then semi-annual unaudited financial statements. So that's an ongoing that you become kind of a quasi-reporting company or public company. Did that answer your question, Ola?
Yeah, yeah. Thank you.
And
Yeah.
I'll just add that because you're dealing with non-accredited investors and you have discretionary control over the funds and you want to charge a management fee, you can't just set up an exempt reporting advisor. You have to be a full-fledged registered investment advisor. And there's ways to do that with the SEC. It's called a multi-state exemption. And it is a lot of compliance work to manage. It's not when you're not just dealing with 10 investors or 50 investors, but potentially thousands of investors. You have to have the infrastructure, the accounting, the systems, the processes, the CRM, and everything's got to integrate nicely, and it's a lot. But if you want to do that, I can show you the roadmap on how to do it. So Kevin, how's it going, man?
Yeah, hi, how you doing? I just had a question for you, Marty, regarding like doing a real estate fund, and if like, for example, with a lot of real estate funds, you get funding. And if I was to, for example, let's say raise 10% of my capital, and let's say I was let's say, for example, raising 20% of capital, and then 80% of it was being given on financing, right? Could that financing go to the GP and then the GP invest that into the LP structure? If we do that, like, you know, so that the GP has that ownership, or what are the implications of, you know, the protections that a fund usually gives you if you do that?
So the GP can invest, you know, can receive LP interest if it invests capital. A lot of times you'll actually see the GP is required to make it like a 1% or 5% capital contribution towards the fund, and buy LP interests, and you know, they're typically, they don't charge themselves a management fee or receive a carry on that. But the issues with doing that would be, you know, you kind of would just want to ask the person why would they, I mean, they could invest in as part of the GP, and receive part of that, you know, be an investor in the GP and receive part of that interest, and the GP could turn around and invest in the LP. That's not a problem. But you just have to kind of look at why, because, you know, that could potentially create some conflicts.
You know what, Marty, what I meant is that if we receive the loan as the GP partners, like we get the loan of the 80% and then we invest that into the LP structure, so we are 80% owner of the fund. Is that something that it can be done, or are there SEC issues with that?
So there's no SEC issues with that. That would just be a hard fund to raise capital for, I think. To try to sell, you know, the investors that, hey, we're going to take 80% and you're going to take 20. Now, again, if there's a loan and you guys are on the hook for it, there should be some sort of accommodation with that. But typically, so let me back up. I have another fund, that a real estate fund, and what happened is, you know, they'll go out and they'll make leveraged investments, right? So they'll take the fund dollars and they'll buy the asset, they'll buy the project, but they'll also put leverage on it. And the GP is like a guarantor on that. So the GP in those situations is actually for guaranteeing those loans, they'll have some sort of kicker in place or compensation for that, so that they, you know, they're getting paid for that guarantee. So that's an idea. But yeah, I don't know if I'm doing a great job answering your question or not, Kevin, sorry.
No, it's okay. The other alternative I was thinking about was just setting up a fund, just like you said, you know, the GP, the LP structure, but then when an investment, you know, when we invest into a certain project, you start another company, and then the GP is the one that receives the loan and invests into that project directly and owns, you know, owns 70% of it, and then you give 30% from the LP structure. Can that be done? Do you understand what I'm saying?
Yeah, I guess what are they getting, you know, what's the LP getting for that 30% that they, you know, just gave up, I guess.
Right, yeah, no, they get 30% that company, you know what I mean?
Yeah.
And we would have 70% on the GP side. We just put the funds into that company, and the LP owns 30%, and the GP gives the loan that we got the 70%. I mean, again, you know, we could have to sell it, but is that possible without any issues?
Yeah, I don't see any, there's no SEC issues. It's just a matter of how you'd structure that. And I'm happy to talk to you about it offline if you want.
Yeah, that's good. Thanks very much, Marty.
All right, guys, I think we got room for one more question. Okay, all right, awesome.
Hey, Ryan.
Somebody,
Hey, Ryan.
What's that?
Yeah, can you hear me, Ryan?
Yep.
Yeah. If nobody has a question, I do have a comment with that you've made before, and particular to the topic of this call. You know, talking about making the prenups and everything else for the 3Ds. All of the paperwork is like 99% of it's for what happens 1% of the time. And the more dating you do and checking out with the partner of doing deals before the fund, you reduce that exponentially of it actually happening within your control, right? Obviously, you can't control death or some of their divorces, but you exponentially reduce the risk of running into that 1% of the time when somebody wants to leave you holding the bag. That's kind of been our experience.
Thanks for the comment, Russ. That's a really good point. Cool. Hey, Aaron Rowe, are you on the call? Oh, maybe not. All right, cool. All right, guys. Well, hey, thanks a bunch for hopping on. Really important topic. So I, take some time to sit down with your partners and maybe walk through some of these discussions and topics. And if you need help, Marty, what's the best way to get in touch with you?
So I just dropped my email address into the chat. Just email's great, mtate@kba.law. Or my phone number is, I'll put that in there as well.
Oh, okay. Give it out your phone number. All right, awesome.
There you go. Got you. You all have my cell phone number now. So, all right.
Awesome.
Yeah. So yeah, and you can shoot me a text as well. So whatever. I'm happy to help.
Oha. So I've been asked a lot about. I'm sorry. Getting asked a lot about recordings. Where can people find these calls? Because I know a lot of folks have a job or you have an appointment or whatever. How do they come back and get some of these calls?
So as of right now, we're going to post them in the Fund Launch Resources tab. So if you just go into your portal, go into Fund Launch, there's going to be Compliance Hour inside Resources tab. So that's where you can find all of those right now.
Awesome. And you guys feel free to reach out to me on Slack, or actually I'll put in my email too. On Slack or my email, or working15@gmail.com. If there's any topics that you want to cover, I'm just trying to add as much value as I can to the group, and I've brought up some important topics, I think, but happy to get some feedback, and let's roll up our sleeves. So on Tuesdays, 1 p.m. Eastern time, we'll be having these weekly calls with Marty. So really appreciate your time, everybody. I think that's it. Have a good one.
Thank you, Marty.
Thanks,
Marty.
Bye.